Welcome to Guilford County's Summit Financial Wellness Series. This morning, we're talking about Social Security and retirement. I want to properly introduce our speaker. His name is Mark Lopresti. He is a certified financial planner. He received his Master of Business Administration and Finance from Pennsylvania State University and his bachelor's in quantitative economics and decision sciences from the University of California at San Diego. Mark's mission is to work one-on-one with individuals, couples, and families to help manage risk, reduce income and estate tax, and distribute assets to their loved ones and favorite charities. So hopefully today we will be able to dazzle you with this topic. And Mark, I will turn it over to you, sir, and stop sharing my screen.
Dazzle, huh? That's a high expectation for Social Security and retirement. Can you still see me? Because I just lost my ability to see. Okay, good. All right, great. So I'm Mark Lopresti. I'm here inside of our Summit Credit Union branches. Just so you know, we have branches all around you here at Guilford County. We've got one on Summit Avenue, South Elm, West Market, and I meet with our members all the time. We're going to talk about Social Security because it's an important piece of retiring, and that's part of my job here at Summit is to help people quit their jobs and retire. So if you want to quit your job and retire, just give me a call. I'll help you figure out how to do it. We can even go over what you're doing and help you give you ideas on how to improve. But we're going to focus on building retirement income today. And we're going to talk about how Social Security's retirement income program helps you do that. We're going to learn about how important it is for most of us. We're going to learn about what other benefits are included in Social Security besides retirement income. And then we're going to go over all the different things you're going to have questions about eventually when you get ready to draw Social Security that I see every day. So if you have questions, feel free at any point to type them into the chat and we'll address them immediately. If you want to speak privately, then I'm sure Lindy will give you my number. Feel free to call me anytime. But let's get started. So Social Security is a great big program, much more than just retirement. It is a very long named program, and we don't really use that name. We just call it Social Security, but some of you may see these acronyms and materials you get in the mail. You see the acronym OASD and even HI now, and that stands for old age, that's OA, S, survivorship, D, disability, and now health insurance. These are all part of the blankets of benefits that we have in this gigantic program of Social Security. Many of you apply for Medicare, and you do that by going into Social Security and enrolling, and then follow up with your Medicare representative for whatever other benefits you need. Social Security is a retirement benefit, but it's more than that, and it does provide retirement benefits sometimes to people that don't even participate in Social Security. So we're going to talk about those. Those happen to be very important in some of the scenarios I work with because people often overlook benefits. Anyway, as a retirement, Social Security is a great big deal. In fact, for a third of the people in America, Social Security is the only income source they have in retirement. And don't kid yourself, for 2/3 of Americans, it is the largest income source they have throughout retirement. So this is a great big benefit for even people that have saved for 30 years, even people that have achieved that $1 million plus net worth. Doesn't matter, the Social Security benefit is equivalent in many cases to $1 million of net worth. So it's a great big benefit. Now we're going to focus on the ways you'll calculate your benefit, how you'll know if it's right or wrong. You can kind of judge a little bit. We're going to talk about how they calculate your benefit, what it's based on. We're going to talk about when you can draw your benefit. We're going to even talk about taxability of benefits if it's taxable. We're going to touch on other benefits you may want to consider, like survivor benefits if you've lost a spouse, or maybe spousal benefits if you were married for 10 years. We're going to even touch on what kids have as protections when they lose a parent and they're young, because there's a protection there in Social Security. So we're really going to talk about a lot. And some of you will have faced scenarios. So, if you want to ask openly so that I can answer out with the rest of the crowd, just think that if you have a question, chances are somebody else does. So by all means, ask about it. All right. So how do we calculate your retirement income from Social Security? Well, some people think that it's based on the last year of work. And some people think that it's based on the last 5 or 7 years of work. And the reason we think that is very often we have other benefits that do work like that. We have pension benefits. You guys at Guilford County, if you've been there for a period of time, have a pension benefit that promises you an income later on when you retire. And that benefit very often is calculated on the last 5 or 7 years, and finally it's adapted to your final compensation. So it's not unusual to see benefits based on 5 and 7 years, but Social Security does not work that way. Social Security has a hard fixed number of years that it uses, and that is 35 years. What that means is they look at your highest 35 years of work. We used to get this mailed out bifold letter once a year that would say, here's your last, 30 years of work, 35 years of work. And what you'll notice is if you hadn't worked 35 years, you'll see some 0 years, and then you'll have some number of years where you earned money. And the problem with Social Security this way is if you didn't have 35 years of work, what they're going to do is calculate your benefit by averaging 35. And if you're missing some of the 35, let's say 10 years you took off to raise children, then they're putting zeros in those years. And that's pulling down the average, weighted average of your 35 years of work history. Really important to know, because oftentimes people ask, when's it best to draw Social Security? And I always ask questions for these reasons, because they don't know that this could impact their benefits. Here's a very common scenario. If you had 34 years of work, then it might be better for you to wait another year and replace a 0 with a income year in order to disproportionately raise your total Social Security benefit. It works a lot like a grade point average did back when we were in school. You had, let's say you had a B average and then you got an F. Suddenly you have a B minus or a C average. And that F, if you could replace it, would dramatically increase your average. So let's just say you replaced a 0 with a $60,000 or something. That would be a big benefit to you. Somebody asked, somebody pointed out in the chat that they had 1 0 year where they actually worked. Okay. If this is very common, by the way, if you were self-employed and maybe you didn't report, or if you worked for an employer that maybe didn't do a good job of reporting, it would be wise for you to try and establish that you had work that year. Find old pay stubs, find old tax returns, and then work with Social Security to change your record. Somebody's now asking in chat, if it's purely the highest 35 years, is it purely the highest 35 years, or is it the highest 35 consecutive years? The answer is it's the highest 35 years. So maybe if you were lucky and in your 20s, you had a super high income and then you dropped out of work and then you started again in your 40s, it's grabbing the highest 35 years, not consecutive. What if you work overseas? That's a tough one. Chances are an overseas employer doesn't report in the US, but maybe you worked for an international company that did. And that's a tough question. I would be asking Social Security how you would integrate that if you can. Remember, if they didn't contribute from your work to the employment, to the Social Security system, then you don't get benefits from it. Matter of fact, if you're self-employed, very often, always, we end up having to pay self-employed taxes, which is essentially a tax that adds up the individual's contribution to Social Security and the employer's contribution. Ends up being around 15%. 2 more questions popped up. Since they no longer send out letters, where do you see? Okay, great question. So let me tell you, Social Security has slowly spent less and less on information and gone more and more to online resources. So the way you get information is you go to ssa.gov, not .com. And then you'll notice there's a link for My Retirement. That's an area where you can create a login. And it asks you for your social security number. So what? They know it. Just know you're at ssa.gov. But you type that in, you create an account, you need to have an email address because they do send you a confirmation email that you have to click a link through like in everything else we have. And then you get to see your actual work history record. When you're logged in, you can see everything that they see. So you can see if you have 34 years, you can see what your estimated benefits are at full benefit age. You can even see estimated benefits at early and late ages and all of that. SSA.gov. Let's see, did I miss any other questions? As you mentioned, yeah, they use the mail, so we see this information that we go about seeing. Okay, yeah, I've answered that. And then great, thank you, Lindy, for posting that link to the SSA.gov website. By the way, this is the best way to enroll in Social Security now. Don't go down to the local office over near Clifton. Don't do that anymore. When you enroll on that website, it's like you're pulling a number in the lobby at the local office. You're in a queue just like everybody else. And when they get to your case, they're going to call you and ask you questions. If there are questions, I've seen people enroll without having to get any calls. I've helped people just do their enrollments. They end up never getting a call, and we specify what date we want the benefit to start. And you can even request a tax form or send in a tax form if you want taxes withheld and that sort of thing. So great questions. So here's the deal. We average up these 35 years, and it's not fair if you just took how much someone earned 25, 30 years ago, because we didn't get paid nearly what we get paid now 35 years ago. So they inflation adjust it. If you earn $10,000 a year, that's probably back in 1970. That's probably like earning $30,000 a year now. So they inflation adjust that up. And each year's inflation adjustment's different based on the consumer price index. And then finally, when everything's inflation adjusted, they average 35 numbers, and that's your benefit. So your benefit's based on 35 years of work history. Now, I've pointed out that if it's worth working more if you don't have 35 years, but very often people ask me, well, when should I draw it? This is a very common question. When should I draw Social Security? When is it optimal for me? We go online or we listen to TV, analysts, and they'll say, everybody should wait till age 70. Well, that's a crazy answer. That's a really crazy answer because it doesn't know a lot about you. It's assuming a great deal about you. I'm going to give you some decisions I base recommendations on. And number one is, what do you need to retire? If you can't retire on what Social Security is paying, and waiting would increase it enough so that it would be enough, then the better answer is draw when it's enough, right? Better yet, let's go back through history. Back about 12 years ago, when we had this great big fall in the markets and a big long recession in 2008, many people were let go. And it didn't really matter if you weren't optimal in your Social Security. Sometimes you turned it on because you needed income, and that was the only source after unemployment benefits ran out. So there are a lot of reasons why we draw it. And one of those is it enough? One of those is, I need the money now. Another one is, when is it optimal financially? And we're going to talk about that one in a little bit, but there's a lot of reasons. It's why I ask a lot of questions. And here at Summit, by the way, we do full comprehensive financial planning. And I'm not asking you or telling you, we just naturally, when you're talking to me, I'm fully financial planning, which means I'm asking a lot of questions, which people get comfortable with more and more because I'm then providing better and better, more accurate advice based on it. And this is one of them. People ask me, when should I draw Social Security? Well, let me say this. Social Security can be drawn early and it can be drawn later, but I'm going to ask Lindy to pull up a chart of the years that we are born to show you when your full benefit age is, because this is the beginning point of understanding how Social Security works. Find the year you were born in this chart, which for many of you, it'll be somewhere in that, years from 55 to 59, but for many of you, it'll be after 60. And know that that is the year that you have your full retirement benefits at Social Security. That's the year where they don't reduce benefits. And for many of you, it's somewhere in the 66 to 67 range. For me, it's 67. That's the year where they consider I'm getting an unreduced benefit. Doesn't mean I have to draw it then. When's the earliest I can draw Social Security? We're going to talk about that in a minute. But that is the benefit amount, by the way, that all other benefits are based on. That's why you want to know this thing called your full retirement age and your primary insurance amount, PIA. That's the full benefit of Social Security. So we're going to take, oh, someone asked, oh no, will there be any left when I retire? Okay, we'll touch on that one later on because I want to get through the heart of this. But yes, people worry, is it going to run out? And we'll talk about that. Let's flip charts now to a chart of red bars on a blue, script page that, there you go. Oh, greenish blue bars. It changed colors on, it used to be red, blue, red, white, blue. Okay, this is a chart of not your benefit. Everybody on this presentation has a different benefit. Okay, there is no one Social Security benefit. It's based on your wages over 35 years, right? So everybody calculates differently, but I want you to draw your attention to the middle bar on this chart where it says $1,000. And that's just making an assumption that you're a person whose full benefit age was 66 and 10 months, okay? May not be your full benefit age, but to illustrate what happens when we draw at different times, this is important. So what you'll notice is if that person with $1,000 of benefit were to draw early, the earliest they could draw is 62. We can all draw at 62, but what you see is it reduces the benefit quite a lot. So that $1,000 benefit by drawing it 3 years early, essentially, reduced it by about 30%. It went from 1,000 down to 700. Now, if yours is 2,000, then it went down to 1,400. So it gives you an idea of how they range. Benefits can be as high as almost $3,000 now, about $2,800, and there is no low. It can be, $50. I don't think I've seen one below 800, but it can be if you didn't work very much. And what you see from this chart is the most you'll reduce if your full benefits right around 66 and 10 months is about 30%. The oldest full benefit age, which is 67, the very next bar from that, they actually reduce their benefits almost 34% by drawing as early as possible. So in a way, we kind of cheat ourselves some Social Security by drawing it too early. And it drops by about 5% a year. It's actually more complex than that. If I could really build this chart out right, it would show that people underneath their full benefit age are reducing their benefit monthly. So it actually goes down just a little bit each month that you draw it early. But if you started at your full benefit age and went past it, it only increases it annually. So something fundamentally changes when we get to our full benefit age. We can dial in monthly different amounts from 62 to 66 or 67. But after that, we really have to make bigger decisions. Do I want to draw this year or wait till my next birthday or my very next birthday? We really shouldn't decide 6 months after our birthday to draw because we've not gotten any real benefit from doing that. In fact, we lost use of money for 6 months and then gotten it, but we've lost use of it. So we've given something up, some opportunity. It would be smart. And in financial planning, what I'm regularly doing with our members is doing some income calculations, some risk calculations, some scenario calculations. And in the income calculations, this is one of 3 or 4, or sometimes 5 and 6 different pieces of income. We're dialing in their income at each month, from 60 to 70 to figure out when is optimal to draw and retire, or when is capable of retirement, and we base it on what you're living on now. So I'll ask you, what are you receiving in net paychecks for you or you and your spouse, after taxes and benefits, and how long have you been getting that? That's my net need. Maybe I don't need that much. Maybe I have a very high income and I could live on much less. So we try to figure out what your real need is, but I regularly base it on what you're earning. And then we dial in our pieces. Okay, here's 62, 63, 62.5 at Social Security. Here's your pension at 62 versus 63. Here's your investments, assuming a certain growth rate, a very low assumption, and what you can afford to draw from your 401k or IRAs. And all those fit together to form this piece. And maybe you have a pension too, all these pieces come together to build a retirement income picture. And then we subject it to tax. So we calculate it, assuming you have no special deductions that others don't have. Standard deductions is how I plan. Worst case planning is what we do. And this is the piece. So know this, it's going up 0.5% for that first, let's say almost year for most people right now, if they drew it at 62. And then once they get past about that first year, it's going up 0.9% each month. So it's a monthly increase, slightly different rates, somewhere around 0.5% a month increase. And then it goes up till you're 66 and 10 months in this chart. And then from there, it just jumps up on the anniversary. Okay, so you've seen how it reduces at 30% or 34% for some people, and it increases too if you wait all the way up to age 70. It keeps increasing at a rate that's near 8%. That's a big deal because you don't know. You're never guaranteed an 8% increase in the stock market, but you are guaranteed a near 8% increase in Social Security. So that's a very certain amount of increase. And that, by the way, once you start these benefits, that is locked in. That's your benefit. It will increase, but at a much slower rate, having to do with inflation. We get a thing called a COLA, or a cost of living adjustment. This year's COLA in Social Security is about 5.5%. It's one of the biggest increases in Social Security ever. Why is it so big? Because inflation is running hot. Costs of everything are going up. In fact, the official cost is that things are going up around 5.5%, but the wholesale price indexes are going up even much hotter than that. And unofficial inflation measures, when you include housing and other things, are actually much, much higher, like double digits, 10, 11, even 14%. So we're getting an increase in Social Security this year that's good, but it's not good enough, really, based on what you're spending on other things. All right, so there we go. We can draw it as early as 62. We can dial it in and start any month we want up to the full benefit age. We can still start any month we want after that, but we don't get an increase in the monthly amount until we hit another birth date, until we get to age 70, at which point, yeah, you got to draw. There's nothing to wait for. You're getting no extra money by waiting after 70. Now, the number one question I get is, when should I draw it? And the first thing I'm going to ask you guys is, well, how do we determine when's best to draw it? We have to know something that none of us can know, and that is when we're going to die. That's one of the things we have to know. I often ask people, is your mom and dad still alive? Well, no, mom died at 57 and dad died at 62 or something like that. Well, chances are genetically, you probably got a lower life expectancy based on that. What was the cause of death? Was it a natural cause or was it an unnatural cause? We're trying to figure out your life expectancy as well as you can. Do you have health conditions? Do you take a lot of prescriptions? Have you had a heart attack? Have you had a cancer? Anything like that that may contribute to whether or not you have a long life to live or not helps you make this decision. For those people that are more of the accountant types, people often ask me, when's it optimal to draw? What's the payback for drawing early versus late? I'm going to give you a number you may want to write down, or some numbers you may want to write down, because it's nowhere in print, and you may want to know this. If you drew as early as 62, there's a payback time frame to this where it becomes a bad decision, financially only, okay? And if you drew at 62, it becomes a bad decision in meaning that you get less in total out of Social Security than you would have gotten had you waited. After somewhere between 12 and 17 years, so write that down, 12 and 17 years is the optimal crossover, meaning you got a little less benefit if you live that long. So let's see it. You're 62. You might start getting less out of the whole benefit by the time you reach age 74, but it may take as long as age 79 before you get a little less benefit. So that then helps you understand, okay, if I don't think I'm going to live to 79, then it behooves me to consider drawing early. My mother died at 67. It behooves me to consider drawing Social Security early. If I die at 67 and I started at 66, then I only got a year's worth of benefit and I paid in for 40 years. So that would be a waste of that benefit. You see what I'm saying? Having an understanding of what you think your life expectancy is really important. And if you're one of those people that, yeah, both parents are alive, they're 91 and they're still going strong and you're just like them, then you should think about at least waiting to full benefit age and even working till age 70 if you want to, or if you have to, just because that's more likely to pay you back a lot more money. What do I mean? Well, if you wait till age 70, man, you got to make it up to the mid 80s before you get more in total out of the system, but you're going to live that long. So it makes sense to do it. And you can make a lot more money in total if you do make it into your 90s. So just think about that. If you start at 62, you get these payments for the first 3-4 years that you wouldn't get otherwise if you waited. And when you add those up, that's a lot of money, right? That's probably $100,000, $200,000. Now you've got to make back $200,000 on your increased payment starting at 66 or 67. It takes a long time to do that. That's what we're talking about here. So deciding when to draw has to do with, do I need it now? I lost my job, think that way. Or can I afford to live on it? Know that when we draw, does somebody ask a question? Oh no, will there be any left? Oh yeah, okay. Know that when we draw early, we're under a restriction. That restriction is that if we want to work and draw Social Security early, we have some limits of how much we can earn. This year, and this changes every single year, but this year, the most we can earn while drawing early Social Security is $18,960. That's about $1,580 a month if you worked all year. And this assumes that you were retired all year on early Social Security. I'm sorry, that you drew it all year. So if you earned drew early Social Security, and then suddenly you worked all year too, and you earned over almost $19,000, you're going to start to have to give back some of your Social Security, $1 for every $2 you earn beyond the $18,960 limit. Now, there's a different limit if it's your first year of drawing. So I will say it's a much higher number your first year, but after that, you're under these restrictions. Next year, I would expect this to go up similarly to the increase from last year, which means it'll be somewhere around 19,500. We don't know yet. But if your plan was to draw early Social Security and work full time, that may not work. How does this work in practice? You go ahead, you do it, and then all of a sudden you'll notice that sometime mid-year, this happens here at Summit, we get calls from people in a panic. My Social Security, it's August, September, my Social Security stopped coming. What did you guys do to my bank account? And the answer is we did nothing. Social Security didn't send. What happened? You earned too much. They know roughly what you're earning. It's being reported, and they stopped paying. That would be a mistake. I've seen accountants make this mistake. They forget this little detail. So it's an easy trap to fall into. When they count what your earnings are, they're talking about your work earnings. Work earnings is called earned income. That's the earnings that pays Social Security and Medicare. It's not withdrawals from savings, retirement accounts, passive income from stocks, dividend stocks. It's only from earned income that you do working. So it's the income that pays Social Security. You could have $1 million of income from other things, but you can't work and draw early Social Security without some reduction when you reach these limits. Now, so we've talked about a couple things already. We've talked about what our benefits are, how they're calculated, 35 years of work history, averaging it out. Everybody's got a different benefit, as low as $800 a month, probably, to as high as $2,800 a month, roughly. That benefit's going up by cost of livings after we draw it. And we can draw it early with a reduction that's permanent, or we can wait monthly and watch it increase till full benefit age, at which case it increases annually at about an 8% clip versus a 5% clip, which is much bigger to wait from full benefit age on up to the max age, 70. And we would decide whether to draw early or late based on our need, based on life expectancy, look at your family history and your health history, all of that. So that's a lot we've covered. And we've talked about, if you do draw early, some of the gotchas with earning too much from work. Now, once you get the full benefit age, earn as much as you want, won't affect your Social Security benefit, but There's still some ways it will affect your Social Security benefit, and it affects all people. We're going to switch topics now to taxes.
Real quick, Mark,
Yeah,
will you answer Jill's question? She's
yeah,
got a
let me
great,
read. So
great
I'm going to read
supplement.
the question. It's, so I will be 67 on February, and how soon do I need to apply? Okay, well, know that they say you can apply as early as 3 months before, but in my experience, unless you have a complicated case, this online stuff has automated a lot of the processing. So benefits can often start 1 month. You can apply 1 month before. I've seen people get benefits as early as 3 weeks after they've applied. They generally pay you about the third week of the month. And so you go online, you go through the apply for benefits after you've looked at your estimates of benefits, and you can put in a date you want it to start, and they'll calculate the reduction or increase if you're on this monthly early benefit. Now let's see, Social Security to be able to start getting benefits after my 60. Okay, so yeah, you could go a month before it and then say I want it to start on my birthday or after my 67th. I've seen people do that many times. And that way you get the stepped up benefit, the max benefit for 67 instead of the 66 and 10 months benefit or something like that. Yeah, great question. Online is great. You can interact with Social Security. By the way, the person in the local office calls you to answer your questions when you put it on the online resource. They also call you to verify your income things or to ask you about spouses, ask you about divorces, stuff like that. We're going to switch gears to tax for a minute, and then we're going to go into some of the other benefits. Let's see. So you do not have to be retired to start receiving. No, you can work and receive Social Security. Just keep in mind, if it's before your full benefit age, you're under this limit of $18,960 this year if you were working all year and drawing it all year. Much higher number if it's your first year, something like $45,000. It's $50,520 this year if you worked and started drawing for the first year. But after that, you're under this much lower number of close to $19,000. After full benefit age, earn $1 million, doesn't matter, you get all your Social Security. Warren Buffett gets his Social Security at full benefit age. And of course, he's 90 or something, so it's he's getting it. Taxability, do we pay taxes? Do we pay taxes on Social Security? Feel free to chime in on chat if you want. I'm going to say this. Many people don't pay taxes on Social Security, but some people do. And it has to do with what your income is and how much. I'm going to ask Lindy to bring up a chart that you guys want to probably write down, because this isn't printed anywhere. You can find it in Social Security's like buried. Actually, you can find this in the tax code, but good luck. Good luck. Your accountant does this with software. I do this back of my hand all the time. But you need to know these numbers if you're single or married. And I want really to point out the difference between what you're all thinking and what really is applying here. We're talking about what your modified adjusted gross income is. We are not talking about the bottom right corner of your tax return adjusted gross income. We are not talking about that. Nowhere does this number appear. You do this little calculation on a worksheet separate from your tax return to figure out how to do your taxes. But what we do essentially is a formula that, Lindy, I don't know if you can bring it up. It's a formula.
Don't see it, I'm sharing it.
Okay. It's a formula that you can do in your head almost. It essentially calculates half. You include half of your Social Security, and then you add to it your other taxable income. So just half of Social Security plus work, 401k withdrawals, IRA withdrawals, dividends. Some people may be special investors that I'm going to just address for a moment. Ignore this, most of you. If you happen to be a municipal bond investor, you often invest in municipal bonds to avoid taxation. Think high income earners want to avoid taxation because they're in high tax brackets, so they invest some money in municipal bonds. And specifically, there's a type of municipal bond called a private activity municipal bond. The tax code says if you have those, these are like for toll roads that earn revenues, stuff like that. You have to add back that non-taxable income into the MAGI for the purposes of calculating taxability of Social Security. But let's keep it simple. Just add half of Social Security and your other income sources, okay? When you do that, think your, Social Security, let's say Social Security is $20,000 a year, so you count 10,000 of it. And then you worked for part-time and earned another $10,000. That's $20,000 of MAGI. Really, that's $30,000 of income, right? But it's $20,000 of MAGI. And let's say you're single. What this chart is showing you is if your MAGI is below $25,000, single filers, MAGI below $25,000, then you do not pay tax on Social Security. But if your MAGI goes $1 over and gets to 25,001 cents, then you pay tax on half of your Social Security. It would be tragic to be drawing out, $100 a month from my 401k and working part-time or something and getting Social Security and go to $25,001. That would be a tragedy, because now all of a sudden you owe an extra couple of $1,000s of tax that you didn't owe for that extra penny. When I'm doing financial planning with you, I am calculating what I believe to be your taxable income based on everything I can gather, hoping to God it's accurate. So I'm verifying as much as possible, because I'm trying to show you why you would increase or decrease withdrawal rates for optimization of tax. And most people are not capable of doing this. There's nothing simple about tax. It's complicated, it's advanced, but it has to do with this. You're trying to avoid crossing a threshold. And someone's saying, still don't see it. The formula, that's okay. Write this down for the formula. 1/2 SS for Social Security plus other taxable income. It's not taxable to withdraw from your savings account, but the interest you earn on your savings is taxable. So you have to add in all your income.
If everyone that does not see the formula.
Yeah,
will
I don't see it either.
Scroll through your Zoom screen options, you should be able to see it.
Gotcha. And I don't see it either, Lindy. I have a big chart of the Social Security percentages. I can't scroll either. At least doesn't look like I can. But that's the simple formula: half Social Security, other taxable incomes. If you cross a threshold from, let's say, a single filer who's earning a MAGI of 25,000, now they're going to count half of their Social Security in their taxable income. And for a married filer, if their MAGI together goes over 32,000, now they're going to include half of Social Security in their taxable income. So if both spouses are taking Social Security and retirement, sorry, the question disappeared. Let me go see if I can catch that again. If both spouses are taking Social Security and retirement, 401ks, is the threshold combined to the 32,000 total? Yep, that's where I was going. So again, if you add up this calculation and you cross over 32,000 as married, now you got to count half of Social Security in your taxable income. And then next level, if your MAGI for a single filer goes above 34,000, or if married filer goes above 44,000, now 85% of Social Security is taxable. That's the most. That's the most. There is no person that pays tax on 100% of Social. Warren Buffett doesn't pay tax on 100% of his Social Security. But could that change? Absolutely. It isn't. It hasn't been changing. That's something I haven't seen talked about touching. But that is a concern, of course, for one of the things we may see. I'm going to see a question here. It says, you'd think that it ought to be 50. Well, we got a woulda, coulda, shouldas. We wish for a lot of things, but this is what it is. What can be done to avoid this? Nothing. Well, I'll tell you what we recommend often to try to manage this. You can't avoid it, but you can manage your income, right? Sometimes you can. Now, you guys are Guilford County employees, so you can't control whether or not you get all of your pension when you elect to draw it. Once you turn it on, it keeps coming, right? But you can control what you withdraw from your 401ks or IRAs. You can control your debt levels so that you don't need as much income when you do finally retire. This is one of the insidious costs of having a high cost of living. If you need more money, you're subjecting yourself to more tax. If you can keep your expenses low, then you can control your tax. This applies to Social Security's taxability, but let me tell you, for early Social Security retirees, it also applies to healthcare, and that's a much bigger deal. I work with some clients who, saved early, retired young, and they can live with almost no health insurance costs while getting full benefit health insurance, better than my own. And I work full time because they can control their income, and the Affordable Care System gives you a subsidy of healthcare costs so that you don't pay a lot for healthcare. There's a lot of things that are affected by income and tested by income. This is one of them. So that's the worst case, is you pay tax on 85% of Social Security. And after that, you're just paying taxes based on your income tax rates. It would be ideal if I could show you how to avoid hitting a threshold or avoid both thresholds and maximizing your draw from your retirements so that they last longer by paying less tax. That's always a wise decision, and that's something I help people do. Would you withdraw 401k before retirement a good option? I try not to. But that's a personal decision, actually, based on a lot of criterion. Please explain this 85% again. All right, people really don't like paying tax on Social Security. I know that, but that's it. If you subject yourself to taxes based on your desires, you will pay tax on 85% of Social Security if you put yourself in these income tax levels. Just keep in mind, MAGI counts half of Social Security. It does not count all of Social Security. To determine how much Social Security pays taxes, that's a complicated statement. Again, I'll say it. You don't count all your income to determine how much tax you pay on Social Security. You do this calculation, separate calculation, to then figure out what you include on your tax forms. And you can make it so that you include none, you can make it so that you include 50%, or you can make it so that you include 85% based on your income sources, which you can choose to draw or not draw. Sometimes you can control that. So you could delay pension to avoid tax on Social Security. You could delay withdrawing the maximum amount that you probably could afford to draw from your 401ks or IRAs to control your income, to avoid hitting these thresholds. Yeah, call me. I'll make it simple, because it's really hard for you guys, it's really hard to learn all these details because they start to mesh together: tax, early withdrawal penalties, pension effects, healthcare effects. You would need a program that doesn't exist. So it's great to work with an expert that knows all these things and does that planning. Truly is worth talking to someone who knows, as a certified financial planner, ongoing education to make sure I stay abreast of the changes every year. There were a lot of changes last year from the Family Cares Act that happened after the pandemic hit, that also affects financial planning. So there's a lot going on. But let's just review. We've talked about how to calculate benefits, who's eligible. Someone asked me after the last event, how much do you have to work to count as a year of work in Social Security? And I didn't remember the answer to that. So I went back and looked, and I talked to that person and shared it with them. It's a very low threshold. We only have to earn somewhere around $4,300. It's online and it changes every year, but it's something like, I think it was $4,185 a year gives you a credit year of Social Security. And know that you need 40 credit quarters, or about 10 years of work, to have a Social Security record you can draw for retirement. But we've talked about how to calculate your benefit based on 35 years, drawing it early or late, what the benefits to it, what the costs or trade-offs are to it. knowing that there's a gotcha for drawing early, right? You can't have too much income, something underneath $18,960 a year in a full year of drawing. Otherwise, you may not get all the Social Security you were counting on. Once you hit full benefit age, no max income, have as much income as you want, but no matter what happens, we talked about tax. We may pay tax, we may not pay tax, depends on our income levels, which we can control a little bit from our decision making. And optimizing your planning for reducing taxes, causing your money to spread out longer is optimal. Seek the advice of an expert that understands tax and law and Social Security benefits to help give you advice on these decisions. We're going to switch gears to survivor benefits. And then if we've got a minute after that, we're going to talk about a couple of strategies that I want everyone to know. Those are advanced, so it's not really important we cover them here. This is about basics, but we're going to talk about survivor benefits and these other benefits. No, and married benefits. If you were married for 10 years and you divorced, but didn't remarry. So if you remarried, forget all this. If you didn't remarry, or you're still married and it's been 10 years, you have two Social Security records. You have the records you're familiar with from your work. You also have your spouse's record. My wife retired 20 years ago. I retired 20 years ago, got really bored. She hasn't worked since then. Her Social Security record's destroyed, right? She has no real record. She worked for 15 years and then retired, something like that. So she has a spousal benefit on my record because I chose to go back and I've been working now for 15 more years. So I mean, big record, spousal benefits there. What's a spousal benefit? Spousal benefit says you can choose your own record or you can choose to draw half of your spouse's income, so half of their Social Security benefit. That's important. You've been married for over 10 years. Maybe you didn't earn as much as your spouse. Probably your benefit's still the better one. But let's say your spouse makes a lot more than you. Let's say that she makes $50,000 and you make $20,000. Then it might be better to draw off of her record than you draw off of your record. Okay. You would look at both if you're married and you would decide the optimal record. You're only going to get half of what your spouse benefit is. So it's they have to have a lot more income for their record to pay you more than your own record because of that cutting in half. And the other gotcha to it is you cannot draw your spousal record unless your spouse is drawing already. So if they're not drawing and you thought you could draw theirs, nope, Social Security will cut you off and say, nope, that's not an active record yet. You can't take it. Well, I'm divorced from them. So your divorced spouse actually affects you when they don't draw Social Security. That's the one time you actually need to know if they're retired or not. I'm going to switch gears now to survivors. Let's say you were married and your spouse died. You have a spousal record still, but now instead of it being half of their record, it's 100% of their record. I have an aunt whose spouse died young 60s, brain cancer, took him very fast, unoperable, and she was 60 years old. Well, she was 59 and a half years old at the time. And she was very afraid. And I don't get involved in family business, but over the phone, we were talking and I said, you sound concerned. I said, I'm a certified financial planner. Let me just ask you, do you want help? Yeah, Mark, I want help. Well, you have a Social Security record. Well, and she works for the state, by the way. And everybody in her offices was saying, you can't draw Social Security till 62. And I said, all of your friends are wrong. I said, they don't know what they're talking about. You need to talk to an expert. You have a Social Security record on your spouse that kicks in now. Survivor benefits kick in at age 60, reduced, but as early as age 60. And we all remember early being age 62 for retirement benefits. Remember I said this is OASDHI, all those benefits? Well, there's different pools of benefits. And yes, retirement benefits start at 62. Spousal benefits, survivor spousal benefits start at age 60. and they're reduced further, but they do start. I said, you have a benefit you could draw at age 60. No, I don't. Yeah, you do. Let's go into your record and see what it is. We went in, we saw it. You could see the sigh of relief, the frustration of how am I going to survive? She was able to retire from the state with almost, 30 years, 26 years, something, 27 years. We bought up a couple of years, draw the spousal survivor record, and do just fine. Imagine that when you were planning on living together, suddenly having to go through a scenario change where you don't know what the future looks like and finding out there's a survivor plan you didn't know about. That's why we talk about these things. Call me if you don't know, if you need help. This still applies if you divorce that spouse, as long as you didn't remarry. And sometimes people say, well, they remarried. Doesn't matter. Doesn't matter if that spouse remarried, as long as you didn't remarry. Okay, so you can pull from both if spouse dies. No. Someone asked the question, can I take both? The answer is never both. Social Security is never going to give you double dips. You're going to choose one benefit. But that opens up a benefit at age 60 you would have not had any other way. You can choose the highest of the two. You can choose survivor benefit now because it's 100%. Maybe that spouse earned a little more than you and their survivor benefit's bigger than your own record. That happens very often. Maybe you choose to draw your spousal benefit because you didn't have a big work history. My wife, she doesn't have a big work history, so she'll draw half of mine, and I'm working, I plan to work till I die, basically, because I like it. And, she'll draw half of mine. And even though it's 50%, it's better than hers, so she'll do that. And then when I die, she'll draw mine. By the way, you switch records. If you're married and you draw a husband or wife, they got to be married now. But they can then take the highest of the two benefits on the death of a spouse. Remember, you don't get both when one spouse dies. Married people never plan for the loss of a spouse. That's a terrible mistake. You have to do scenario planning in all your planning, or you're just setting yourself up for failure. But you can choose the higher of the two benefits. Now, I will say this. We talked about drawing early, and I know we're out of time. We know that when we draw early from full benefit age before, we know we reduce our benefits. We also reduce our spousal benefits proportionally. And our spouse, when they draw early, they're not only reducing their record, they're reducing the spousal benefit you can draw. And then if you draw early, you're reducing it even further. So you can have a double reduction if both spouses draw early and you draw the spousal benefit. So spousal benefits are very reduced by early withdrawals. Just be aware of that. And then we do lose a benefit when one spouse dies. So we can switch records to the others when one spouse dies. I think we've run out of time. I'm going to see if there's any questions here.
Yes,
you do
Mark,
not have
we
to
have several questions.
Okay, yeah, let's run through those because that's what we want to address. Do you have to be a member to be? Call me. I help everybody that calls. Ultimately, becoming a member of Summit is free to anyone at Guilford County. I mean, we offer free checking and, our services are free for financial planning. So by all means, call me. There's no reason not to. Will you need to open an account? No, I don't think you will, but there's nothing to hold you back from it. And very often, if we're helping you, the very next thing people tell me to do, I mean, they almost demand it is do this, implement your plan. And then I end up saying, well, we got to do this, this, and this. And that involves setting up an account, which means nothing other than putting $5 in an account. It's no big deal. All right. You do not have to be. Okay. Somebody said that. What was some of the earlier questions? Because I can't see them. Let's scroll up here. What if you choose the half of your spouse when your spouse is living? You can switch to 100% of spouse when your spouse dies, right? The answer is yes. Yes. But remember, there's still that reduction factor thing. So maybe your spouse drew at full benefit age, unreduced, but you drew at 62, reduced. So you took the half of theirs and you reduced it further for early draw. That reduction is permanent. So when you do switch over to your spouse's benefit, yes, it's bigger, but it's reduced by the reduction factor you applied to it for drawing early. Again, it's complicated stuff. So I don't want you guys to, a month from now, say, you said something else. I'm not saying too much here because it's very easy to misinterpret and get this wrong. I've had people misinterpret. and say, you said, and I didn't. That happens very often around tax. I've had CPAs say, you said, and then I show them what I said, and they go, oh, I didn't understand you. All right, let's see if there's any other questions here. Just to confirm, if you are divorced, been married for 10 years, you can still pull from your ex, even if they remarry. The answer is yes, even if they've been remarried for 10 years. I don't care how long they've been remarried. I don't care if they divorced 3 different people. As long as you didn't remarry, you have a spousal record. Once you remarry, you've gotten rid of your spousal record. That's the only way you're going to lose your spousal record. All right, let's see if there's another question there. This is the great, okay, thank you. Yeah. All right, good. Looks like people are checking out because we've got no time, and I know you guys are at work. There's always.
There was just 2 questions, and I'll mention them just in case they're still on. How do capital gains on investments affect this taxable amount?
Okay, yep. Capital gains apply to your income, and if your incomes go above these thresholds of Magi, then they affect your Social Security.
Thank you. And the second question, do all of the rules that you mentioned about taxes apply to disability retirement?
Disability acts very similarly. Now, there's 2 different disability programs. There's SSI and SSDI. And SSI looks at your income rather harshly. Think about this as the hardest benefit to get. Blind people automatically qualify, but everything else tends to have to fight for it, prove it, get a lot of doctors, take 5 years, hire an attorney to fight for it. And they look at incomes very harshly. And very often those incomes are so low that those people don't pay tax for that reason. But SSDI doesn't look as harshly at income. You could have a $30,000 income, for example, with SSDI. And in that case, taxes do start to affect your benefits. Not because the benefits were never not taxable or taxable, it's just you're earning more, and that's when they start to become taxable. Complicated stuff. Was there any others?
That's it. We appreciate all of your time, and thank you so much. I hope that you got all of your questions answered, but if you didn't, that's what Mark's there for. So please use him as a resource. And of course, reach out to me if you need me. My extension here is 6259, 336-6259. Have a great day.